If you're an individual investor or a professional with a CFA designation, you need to watch this video. Are you aware your portfolio is most likely providing abysmal returns? But more importantly, do you know why your portfolio is underperforming? Stick around to find out why and what you can do about it. Most investors, whether they're aware of it or not, manage their portfolios to lose less rather than to gain more. The end result is they still end up losing, but with gains much lower than they could have with just a couple of small changes. Look, we've all heard the common wisdoms. You must diversify your portfolio, and pigs get fat and hogs get slaughtered. There are two reasons why most investors, professional or retail, will never beat the S&P 500. What are they? The first reason I've covered in several of my previous videos, and I'll put links at the end of this video and also in the pinned comments below. And that reason is most investors' overuse of diversification. The second reason, and the subject of this video, is another common wisdom that turns out to not be very wise, and that is rebalance. So let's talk about arithmetic versus geometric returns really quickly here. This won't be painful. Arithmetic returns kind of add up the way most people think they would. So if I have an investment that returns 30% a year, the logic to me says, okay, well, over 5 years, I'm going to get 150% gain, right? 5 times 30% equals 150%. Well, that's if those returns add up arithmetically. But in reality, most returns grow in a compound way, so they grow geometrically. So if I take those same 30% per year returns, and you think about it, so the first year my portfolio grows by 130%, and then the second year it grows by another 130%, so that's 130% times 130%. And you can see here what you end up with is
1.3 times 1.3 times 1.3 times 1.3 times 1.3,
which equals 3.71. Now I have to subtract 1 to get the total percent change, and instead of 150%, that compound annual growth turns out to be 271%. That's a whole different ballgame. To demonstrate this, let's take two investments and put them together and see what happens. Cash and Apple, going back 24 years to March 10th, 1999. Let's assume we were able to get a 1.48% compound annual growth, or CAGR, on the cash over that 24 years. And Apple over that same time frame had a 30.66 compound annual growth rate, which it did. So if you think about it, and we average those two returns together, you should end up with about a 16.81% return, right? Well, what if I told you that depending on how you manage that portfolio, you could end up with a return of almost 27% managing it one way, or a low return of less than 6% managing it another? Let me show you how both of those situations are possible. So I know there's a lot going on here on this spreadsheet, but just bear with me. We're going to put 50% of our money into Apple, which had a 30.66% compound annual growth rate over that 20-plus year period. And then we're going to take the other 50% and put it in cash, where the cash had a 1.48% compound annual growth rate. And in this first example, I'm not going to let either one of those get to be more than 55% of my portfolio. So you can see that here. I've set the maximum position percentage to 55%. So what happens to our portfolio? Well, over that 24-year period of time, my portfolio had a compound annual growth rate of 5.52% and a maximum loss of over 70%. That's a big loss and not much return. And just for reference, how much return and loss did Apple have? Well, if we make the portfolio 100% Apple, then obviously Apple had a 30.66% annual rate of return, but it had an even worse loss of almost 82%. That's huge. So by mixing 50% Apple and 50% cash, we certainly improved the maximum loss a little bit, but boy, did we kill the return by rebalancing it a lot. So let's go to the other extreme. What if we never rebalance it? So now I'm going to let the maximum position percent grow to 100%. So if Apple becomes 100% of the portfolio, which it pretty much does by the end, you can see that now my return is much better. It's 26.92%, not quite the 30.66% of Apple, but my maximum loss also improved a bit here. So now I'm at call it 66% instead of minus 81% or minus 71%. So there is some improvement here. But the important part of this exercise is you can see that by rebalancing too much, I really kill the returns here. So how do I get to that average return of 16 point something percent return that we talked about earlier? Well, if I let Apple or cash grow to be 80% of the portfolio, then we're right about that average return that we talked about earlier. But the maximum loss even gets better. It's minus 54%, almost minus 55%. So that's a big improvement in maximum loss and a fairly good return here. So you can see that you need to play with this. You can't just rebalance every time something gets a little out of whack. You got to let it expand somewhat, and the end result can be better returns and better loss characteristics. So before we jump into a little bit more of a complicated portfolio to show this concept, why is the S&P 500 so hard to beat? The real answer comes down to the fact that the S&P 500 index is market cap weighted. Now, what does that mean? Well, if Apple is 5% of the entire market capitalization of all the S&P 500 companies, then Apple will be weighted at 5%. So you can see here in this table how this works out. Apple is clearly the largest market cap company in the S&P 500, and you can see here that it's weighted at 5.86%. Microsoft is second at a little over 5%. Amazon third, 2.31%, and you can see how this falls off as the companies become smaller in their market caps. So I think you kind of get the idea here. Now, if I, as a money manager, have a lot of stocks in my portfolio, and I only let any one stock get to a certain size or certain percentage of my portfolio, then I'm not doing what the S&P 500 does. So if Apple or Tesla or one of these companies was able to grow to 10 or 20% of the market cap of the S&P, I don't think there's any restrictions in the S&P stopping it from growing to that percentage of the weighting. So the winners can run and the losers shrink. That's what should happen in a portfolio to get the optimum results. To see how this works, let's look at a slightly more complicated portfolio to see how this rebalancing affects both the return and the maximum loss. But before we jump into that, there are 3 ways to rebalance your portfolio. Let's talk about those. The first way is to just simply rebalance at regular time intervals. Now, we're not going to look into that here, but it should work out pretty much similar to what I'm going to show you in these other 2 ways of doing it. A second way to rebalance a portfolio is to decide that you're not going to let any one stock become larger than a certain percentage of the portfolio. In a lot of cases, money managers arbitrarily say, okay, I'm not going to let any stock get bigger than 10% of my portfolio. And in fact, that's what Cathie Wood does from ARK Invest. And the third way, and it's a little bit subtly different than the second way, is to decide to not let any stock grow more than some percentage above its target percentage. And for purposes here, we'll call that percent out of balance. Let's keep it simple. So if I have 10 stocks in my portfolio and I say the target is that each stock should be 10% of the portfolio, and then we decide, okay, well, we're not going to let any stock get more than 20% out of whack, meaning if that stock gets to 12%, we trim it back to 10. If it gets down to 8%, so 20% lower, we bring it back up to 10%. So those are the conditions that would cause a rebalance to occur. Let's walk through a couple of those scenarios and see what kinds of impacts this has on portfolio performance. So what I've done here is I've created a very simple portfolio using some cash, 4% cash, And then I'm using 1, 2, 3, 4, 5, 6 stocks. And I just picked these stocks. Yeah, you can say, I know, I have future knowledge, all that, blah, blah, blah. That's fine. I'm just trying to demonstrate a point here, not show you that I can make great performance by picking stocks that I already know performed well. So what I did is I put 16% in each of the 6 stocks, and that leaves us with 4% left over for cash. Now, in the first case, I'm going to use the maximum percentage method, meaning that I'm going to say any of these stocks can't get bigger than 20%. If it gets bigger than 20%, we're going to rebalance the portfolio. And you can see I've got that set here to 20%. What's my portfolio return and maximum loss? Well, my portfolio return is 10.27%. That's pretty good. And my maximum loss is 45.76%. That's pretty good too. Well, what if I increase this? So now instead of 20%, maybe I let the stocks grow to 40%. So let's bump that up. Well, you can see that my return went up and my maximum loss actually improved a little bit here. What if I bump this to 60%? Okay, well, if I bump it to 60%, my return certainly goes up, but now my maximum loss got a little bit worse. This is a trade-off you have to play if you're going to be a money manager. And what if I go to 80%? So if I go to 80%, return goes up again. Now we're at over 16%, and my maximum loss goes to minus 54%. And finally, let's just let the thing run wild. We'll make it so that any stock can go to 100% of the portfolio. And you can see that I'm getting my biggest return here at 21.19%, and my maximum loss is kind of flatlined at minus 54%. Now, you can see the problem here is that Apple ends up being 96% of the portfolio at some point during this process. But you can also see that each of the investments ends up realizing its full potential during this time frame. So why does rebalancing too much negatively affect returns? Well, let's take a look at that. So let's go back to the scenario where I'm now not allowing any stock to become, or cash, to become more than 20% of my portfolio. Now, in this case, what you'll see here are the returns of each of these components over that 24-year period. But I've also calculated the position growth. So obviously, cash didn't return 10.88% over that 24 years, but that position grew at a compound annual growth rate of 10.88% per year because I was taking money away from my high performers like Apple, and I was putting it in cash. So that position was growing as a result. And you can see pretty much across the board, cash grew at way more than its annual return. Coke grew way more than its annual return. Disney grew more than its annual return. Microsoft grew a little bit less than its annual return. Procter & Gamble grew more than its annual return. Apple grew way less than its annual return. And IBM grew way more than its annual return. The position, not the stock itself. So what you're doing when you rebalance too much is you're taking money away from your winners and you're giving it to your losers. And by the way, the same thing happens if we use the out of balance method, where we say a particular stock can only get out of kilter by, let's say, 5 or 10 or 20% from its target value. So let's take a look at what happens there. So in this case, I've set this to run the out of balance method, and we're going to allow each one of these positions to get 5% out of balance, meaning that this can grow to 16.8%, and then it's going to trigger a rebalance. Or cash can grow to 4.2%, and it triggers a rebalance. So what you can see here is this portfolio now has an 11.69% return and a 41% loss. That looks pretty good, but what I've done again is I've limited my high flyers like Apple from growing to anywhere near its potential in terms of compound annual growth rate. And again, cash has a much bigger return than it should have because I'm taking money from my winners and moving it over to my lower return portfolio components. So let's bump this up to, let's say, a 10% out of balance percent. Now you can see the return went up just a little bit and the maximum loss went up a little bit. Let's double this and go to 20%. Yep, return going up, but also maximum loss going up. Let's go to 60%. Again, return moving higher, just as in the previous example that we did. Let's go to 80%. Return at 21.04%. Maximum loss at 54.03%. And then if we push it to the limit, I think we're already there. Yeah, it goes up. The return goes up a little bit. The maximum loss stays the same. So now this is exactly equivalent where we had the max percent of the portfolio. You see the returns and the maximum losses don't change here. So what I've done here is I've plotted all of the returns and all of the maximum losses for the maximum percent holding. You remember where we say a particular holding can't be more than 10% or 20% of the portfolio. And I've done the same thing for the percent out of balance, where you say, okay, if this is 10% of my portfolio, it can't grow or shrink more than 5% before I rebalance. And you can see all the numbers here and how they played out. And what I've also done is I've said over the entire time period, what was the maximum level each one of these components got to here. So in the maximum percent holding, I said no holding can get more than 20%. And what happened? Well, some of these got to be 20, maybe 21% before they got rebalanced, but you can see none of them exceeded 20% by much at all. Cash obviously never got there because it doesn't grow on its own. And then if we move to 30%, similar scenario. Some of these never made it to 30%. Obviously, Microsoft and Apple, the two better performers, made it to 30% before they got rebalanced. And then if we go up to 100% here, where we just let everything run wild, you can see that Apple ended up as 96% of the portfolio at some point during that time frame. Now, if we use percent out of balance, you basically get to the same place a little differently. So now these are not going to necessarily cap out at 20%, although they did here. But as we move the numbers up, let's go to 60%, you can see that these are a little bit more scattered all over the place. 19, 23, 24, 76. So there's a lot more variability as you increase the out of balance percentages. So why does rebalancing negatively affect returns, and why do most money managers and retail investors underperform the S&P 500 and other benchmarks? Well, just like the one stock and cash example that I showed at the beginning of this video, when you artificially cap the growth of one of the components by rebalancing, you're taking growth away from your best performers and distributing it to your lesser performers. That doesn't make any sense. The net result is you end up performing more like the lower performers and less like the high performers in your portfolio. Just imagine a football game where you limit your best players to only one play per game. Nobody in their right mind would ever do that. So why would you do that with your portfolio? I'm Calvin Rose, and thank you for watching Invest Smarter today. If you like this video, please hit the like, subscribe, and notification bell so you won't miss an upcoming episode of Invest Smarter. That's all for now.